Now, the business, and here's Dominic.
Hello. We learnt a bit about why Lehman Brothers went bust today, because a report into the collapse of the bank has criticised senior executives and the auditor Ernst & Young for serious lapses that led to the firm's collapse. The report showed that Lehman was insolvent for weeks before it filed for the bankruptcy, and it used accounting tricks to hide much of its borrowings from the public eye. It went on to claim there could be grounds for legal action against the former chief executive Dick Fuld and his chief financial officers. Well, joining me now in the studio is Chris Roebuck from Cass Business School. Chris, thanks for coming in. So basically, we learnt today that Lehman's was much more heavily borrowed than the markets thought, and this was crucial.
Absolutely. For the people listening, what that means is it's like you having a mortgage that's 125% of your property and then telling other people who ask you how big the mortgage is that it's only 80%. So you're giving them a completely false impression of the reality of the situation.
So the markets think you're more creditworthy than you are, and that would affect their level of borrowing, because if the markets had known that they were so heavily borrowed, perhaps they wouldn't have been dealing with Lehman's.
Oh, certainly that's true. You know, you're dealing with somebody and the level of risk in terms of dealing with them is much higher than you actually believe, and therefore either you wouldn't do business with them or you'd certainly charge more.
And we're talking about some quite significant sums of money, aren't we? For example, the assets were actually almost $40 billion lower than was really the case at the end of the 2007 financial year. That rose to $50 billion by the middle of 2008. So actually they had much less of a buffer than the markets thought.
Absolutely. I mean, that level of debt that was hidden would have made a significant difference to people actually saying, do we do business with these people? And the other issue is that those accounts that they presented were confirmed by the auditors. Right. And that gave people the confidence to say, well, if these have been confirmed by the auditors, they must be okay. So that's another question to be answered.
It's this whole trend, isn't it, that's been sort of concurrent throughout the whole crisis, which is the trend to hide things. Rules are there for a reason, to protect banks. So why were banks trying to hide things?
The issue is this unending drive for profit. If we can get that little bit of extra profit out by not being illegal, I mean, the issue here is there is a question as to whether they were being illegal or not. The question is, are we prepared to push how we get profit past what most people would think is moral and right? And I think that's a big question for the banking world and for the corporate world as to whether the people in charge should be doing the things that are right or the things that actually are immoral but make money.
Chris Roebuck from Cass Business School. Thank you. Very interesting.